Now time for a special interview while the market is just about trying to recover back into the green. And I think the broader markets are already sort of on their way. At least I can say that for the small cap index. It's a bit of a tug of war at play, actually. You've got private banks on one hand actually holding up, but look at the weakness in IT. That's getting really thrashed. So let's try and understand what exactly is the fate for not just equity markets, but the economy and overall the world, which is just ever so changing. Who better than Sunil Koul, the global emerging market equity strategist at Goldman Sachs, joining in on the show right now. Sunil, hi, good to have you on the show. Sunil, I was just going through your report, which talked about as to how local headwinds seem to be stabilizing. And you've mentioned that, the GDP growth has likely bottomed out with a gradual recovery that you're expecting. Tell me, what are the primary drivers behind the projection recovery to 6.4% of a growth rate in calendar year 25, and especially at a time when we're talking about a global slowdown led by US?
Yeah, sure, Aisha. First of all, welcome, and thanks for inviting me back. Look, I think we still think that the September quarter number was the trough in terms of GDP growth. We are actually expecting the recovery, which is, I think, in line with what the street is expecting as well. But I think the key point is what you just mentioned, is that the recovery we think will be gradual. Partly because we think policy at the margin is still somewhat restrictive, right? Because we still are looking for fiscal consolidation this year, even though the extent of fiscal consolidation will be lesser this year than it was in the previous year. So there will be less drag on growth. But at the same time, I think the monetary policy is turning supportive, with RBI both easing liquidity, but as well as sort of cutting rates. And obviously, the macroprudential measures have also somewhat turned more favorable. So at the margin, I would say policy is turning somewhat favorable, at least on the monetary side. And then we are also expecting some pickup or recovery in the consumption. Again, when we think about consumption, as we know, Aisha, I mean, there is the high-end consumption, which still has been holding up pretty okay. There is a mass market consumption, which has been slowing down. We think things might start to improve in a couple of quarters. And then there is the rural consumption, which actually has been picking up quite a bit from lows, because the sowing season has been decent. I think barring any weather shocks, if the harvest is okay, we actually might see an improvement in the rural economies. I think the private capex obviously has been lagging, but the improvement in sort of policy, as well as kind of consumption picking up a little bit, and exports still holding up, should get us to a recovery in growth. But I think the key point is that the recovery will be somewhat gradual than what I think the markets are anticipating.
I must say, I so envy you, because it's almost a heat wave here in Mumbai and many other parts of the country. And you must be having such good weather in London, because, my bigger concern is what happens to inflation, because we're headed in for a very hot summer. And I hope monsoon is on time, because that's going to have a huge bearing on inflation as well. But anyway, that aside, what sectors then do you think, Sunil, are going to sort of propel this gradual recovery in growth? And would it continue to be premiumization and urban consumption?
Yeah, I mean, we still like the premiumization story. We still like pockets of urban consumption. We like to play, I think in general, if you look at our sector allocations, we have a tilt of consumption over investments. And so we like to play the consumption story through the autos, which is partly, I think, the premiumization story, which we just mentioned, but part of it is also the recovery in the rural through tractors and two-wheelers. And so I think auto continues to be our one of the favorite picks within consumption. We have also upgraded staples recently. I think the key view there being that the volume growth has already been recovering in the recent quarters, as we know, but we also think that the companies may be able to take up some price hikes, which means the margin pressures which we were seeing in previous quarters may start to ease. And so a combination of slightly better volume growth or continuing improvement in the volume growth with sort of easing margin pressures means you have improving profitability for staples. So I think those will be the two cohorts from the consumption side of things. In addition to that, we also think that it still makes sense to be sticking to the quality sectors, somewhat more defensively positioned within our allocations, having a sort of quality tilt. So we still have a sort of overweights on telcos, overweights on insurance. We also have IT as overweight. So all three of them are relatively kind of defensive sectors. And where we have more cautious views, as you are just mentioning, is more sort of capex intensive sectors. Cement comes in there as well. I mean, durables are there, but we have also sort of taken sort of industrials down from being overweight to neutral a few months back. So in general, I think it's consumption over investments and sort of somewhat more defensive in our allocations. And we have also been a bit more cautious on sectors that could get impacted from the potential tariff that could come through in April once the US decides on reciprocal tariffs and other tariff related issues. And I think pharma could be the one that could be impacted there. Metals are also something that could get impacted. So we are also underweight those spaces.
Sure. You've given us a lot of food for thought. But let me first talk about, the context of EPS downgrade cycle, right? Because that's what sort of burst the bubble for equity markets. How do you interpret the moderation in the pace of cuts? And what factors do you think are contributing to the stabilization of earnings sentiment overall, if at all?
Yeah, I mean, I think that was the core view we had when we sort of downgraded the market about 5 months back in October, and I think that the view was that there has been a cyclical slowdown in growth we are seeing, and that should sort of filter into the micro in terms of earnings, and that's exactly what we saw in the September quarter. I think September quarter was one of the worst we had seen in a while in terms of EPS downgrades. So if you looked at, for example, not the extent of revisions, which was about 3% in terms of MSCI India EPS integer, but the breadth of revisions in terms of how many companies are getting numbers upgraded versus downgraded. So during the September quarter, out of the BSE 200 companies, almost 8 out of every 10 companies were actually seeing downgrades during that quarter. I think if you look at the December quarter, we already saw a bit of improvement there. I think we are still in an EPS downgrade cycle, but just to sort of compare the numbers. So for BSE 200 in the December quarter, we saw about sort of 6 out of 10 companies seeing downgrades. So at the margin, still more companies seeing downgrades than upgrades, but I think that pace of downgrades has stabilized. And I think that's in line with the recovery in the growth we saw in terms of the September quarter print was the lowest, and then you saw a recovery in the December quarter print. And so I think things are kind of stabilizing at the margin, but we still think that the downgrade cycle is not over. We think that it probably takes a couple of quarters for things to turn on the EPS side. Especially, I think if you keep into the mind, as you mentioned, that the global growth is also kind of slowing down, or more specifically, I think the US growth has been seeing some signs of slowdown that could also start to impact the broader growth backdrop.
Sure. But Sunil, one can safely say that large cap valuations have moderated to decent and bearable levels. But when it comes to SMIDs, because that's where, all the froth was concentrated, do you still see risks, and do you still think that, the valuations haven't corrected enough, even though at an index level we've fallen about 22% on the mid-cap index and I think 27 odd on the small caps?
Absolutely, Aisha. I mean, that's exactly our view. I think you're right in pointing out that if you look at the large cap space, their valuations have corrected. I mean, whether you sort of look at Nifty or even MSCI India, which is kind of large plus mid, but in both cases, I think Nifty is trading sub 20 times, 18, 19 times forward PE. MSCI India is close to 20 times forward PE. In both cases, I think numbers have come closer to where we think the fair value for the market is. In terms of looking at the global environment, local environment, we think we're kind of already there in terms of valuations. And we have seen a broad-based decline in sectoral valuations across most pockets within the large caps. I think where we still are, we think there is more to go is the small and mid-cap segment. I think there, if you look at valuations, we are still looking at sort of high 20s to possibly closer to 30 times PE at the aggregate level, and things still more than one standard deviations above mean. And if you look at the median stock valuation, that's still a little bit even more expensive. And so I think there is further risk in the mid and small cap segment, especially if you look at from the positioning standpoint. As we all know, I think those are the pockets wherein we had domestic institutions and retail positioning got into very extreme or elevated levels over the last few years. And there, I think we haven't seen any major signs of sort of moderation yet. I mean, obviously, we just had the AMFI numbers out and the SIP numbers out. Clearly, some moderation in the flows there, but we haven't seen, for example, SIV flows come off a lot. And so I think there is still quite a bit of retail stroke domestic institutional positioning in mid and small caps, and so there could be more risk there. And so I think in terms of the preference within caps, we still have a preference of large caps versus kind of mid and small caps in our allocation.
Sunil, in this volatile world right now, does it even make sense to try and time a potential market recovery? I know I'm sort of digressing from what we were discussing before this.
Look, I think given the global uncertainties out there, Aisha, our sense is that the market is likely to be range bound here. Especially, I think over the next 1 month, things are still going to be pretty volatile as we head closer to that April deadline in terms of the US tariffs. And just to kind of slightly digress here, I think in our baseline expectations, we actually have downgraded our US GDP growth forecast from sort of 2.4 to 1.7% this year. And this is the first time in 2.5 years we are actually below consensus on US growth. And this is not necessarily because we think there is a lot of the material weakness in the data in there, but it's largely coming in from our view that our baseline expectations of tariffs have actually gone meaningfully higher compared to what we thought a month or so ago. And so we do think that there will be tariffs on critical imports, about 10% tariffs there, tariffs on global autos, and potentially some tariffs on reciprocal tariffs, where India could be impacted to the extent of 6 to 13% higher effective tariff rates, depending on whether the US administration goes for product level or country level sort of reciprocal tariffs. And a lot of those issues will be decided in April in terms of deadlines there. And so we think, therefore, the market is likely to be volatile over the next month till you head into that sort of important deadline in terms of tariffs. And from that standpoint, I would say our base case is that market kind of remains range bound here. So our near-term 3-month target on Nifty is more like 23,000, which is where we are more or less there. And so more a range-bound market. But then I think as earnings do come through, which we are baking in about sort of 12% earnings for the full year, we think markets can recover over the 12-month period to our target of 25,500, which is about 13% upside from current levels. So if we do get the underlying earnings of low teens, I think we can still make decent progress over a 12-month period. But I think in terms of your question about timing, we would still be cautious over the next month or so and see what comes out of on the tariff front.
You know, you did touch upon the local flows, and I want to discuss this significant $27 billion of outflows that we've seen from FIIs and FPIs since the September peak. We've already seen that implications, but up until now, you've got the DII sort of cushioning the market, if you will. What do you think is going to make the foreign investor come back now that there seems to be a little hint of a reversal in the dollar, provided it was just a currency play and not an India-specific case?
Yeah, I mean, you're right. Look, I think the dollar has obviously weakened quite a bit, but a lot of that, and which is good for all emerging markets, including India. But I think a lot of that is contingent on the fact that we are seeing so-called US exceptionalism sort of fading out a little bit, in the sense that US was actually growing much better than everybody else. Whereas I think what we have seen over the last sort of few months is that you're actually seeing US growth slow down a little bit, but at the same time, we are actually seeing fiscal in China as well as Europe. And so the global growth picture is looking somewhat more balanced, which is why I think it has put incremental pressure on dollar. I mean, so we have also on our side sort of tempered our expectations of dollar strength, but I think there is a risk that as tariffs come back, dollar could go higher. And so I think that still remains a risk. I mean, when it comes to the FII flows, therefore, Aisha, I think you're right. I think the extent of sell-off we have seen to the close to 28 billion, and that's not even including or adjusting for the deals and the IPOs. If you adjust for that, the extent of selling is probably more than 30 billion, which is quite a meaningful number, and it's the second largest FII selling in India's history. It's the fastest pace of foreign selling we have seen, which is why I think the foreign flows are looking cleaner. But for flows to come back in, I think it still seems there is, as we discussed, too much global uncertainty, which makes it tougher for people to either put capex to work or put sort of investments to work. And so I think we are a bit sort of cautious on flows in the near term. And at the same time, as I said, there is more somewhat excitement within the investor conversations on places like China and Europe. And we obviously, if you look at the year-to-date performance, that's kind of reflected there as well, wherein both Chinese equities markets and Europe has done much better than everybody else. And so in that sense, I think we think in the near term, flows may remain subdued in India. And I think as people start to see numbers bottoming out, growth kind of coming back, you might see FII flows coming back. But that probably will take a couple of quarters before that happens.
Interesting. Sunil, also your report mentions a focus on oversold stocks with strong fundamentals. Tell me, what have been the findings? What methodology did you use to identify these stocks? I'm quite curious about that.
Yeah, I mean, look, I think it still remains a market, as we know. If the headline index is down, depending on which index you look at, but as you said, SMIDs are down 20%. Even in dollar terms, Nifty is down from peak to trough close to 19%, right? So when the headline index is down that much, you have good quality companies that are down sort of 20, 30, 40%, even 40% in some cases, right? And so we have been getting more and more questions incrementally from investors in terms of, is it time to obviously buy the dip, but incrementally, should we be sort of bottom fishing and buying some good quality companies? And so I think what we have been sort of looking in our research is companies where we have sort of buy ratings and where our analysts still like those companies fundamentally, but you either have seen large price declines, let's call it more than 20, 30% declines, or the stock is kind of trading at 52-week low, which is kind of pure price correction. But we are also looking at a couple of fundamental metrics. So stuff or stocks where valuations have gotten way below, or at least half a standard deviation below the long-term average, stocks where multiples have corrected, but earnings have been resilient. And so I think if you look at combination of these factors, we did highlight a group of 16 stocks in our research where I think which meet most of these criteria. And so I think the bottom line there is that even though we are not ready to take the broad-based beta risk in Indian equities right now, and we still are sticking with the overall market weight stance on Indian equities within the context of Asia or emerging markets, we do think that selectively people can buy some of these quality companies that have some of these characteristics. But in general, I think the view still remains that you want to stick with quality, and things like companies where we have resilient earnings, high ROEs, strong balance sheets, less EPS cuts are the ones which we are preferring from a stock picking perspective.
Interesting. And at the same time scary as well, because it seems like it's going to be a very puzzled next 1 month and maybe next 1 year as well. So very quickly, Sunil, to conclude, how do you advise investors should try and balance risk as well as opportunities when it comes to Indian equities, particularly in relation to small and mid caps? Do you now need to clearly make that distinction, which you never did, because it was all about either sectoral allocations or individual stocks, which India has always known to be a market of? But do you now need to have clearly a very large allocation to large caps and a smaller exposure to mid and small caps?
I mean, yeah, I think that makes sense here. As I said, I mean, from a market cap perspective, I mean, obviously we have a preference for large caps over small caps. I mean, obviously you can't choose just based on cap. You obviously look at the underlying fundamentals and what the stock is priced on. But I would say two things. One, I think if you look at our sector allocations, as I mentioned earlier, there is clearly a balanced approach we have. So there's a mix of domestic sectors and external sectors. There is also a mix of cyclicals versus defensives, whether you sort of look at autos versus kind of a staple or a telco. And so in that sense, I think we have a much more balanced approach in our sector allocations compared to a year or so back or last few years, wherein we were very much domestic cyclical oriented. And we did like many of the smaller cap and mid cap themes as well, whether it's energy security, defense, railways, all of that stuff, right? And so I think there are a lot of these micro stories which we like, but right now we kind of A, more balanced in our portfolios, and B, even within sectors we have been sort of favoring sort of the leaders, market leaders, and large caps in many sectors. Banks is a good example as well, given the latest news flow, wherein we have incrementally more preference towards larger banks than sort of mid-sized banks. So I think that approach makes broader sense when you want to kind of stick with larger companies, quality companies that have better fundamentals than the small and mid caps in some cases.
Interesting. Sunil, so good chatting with you today. Thank you so much for your time.
Pleasure to be here.
Thanks.